Can go ahead and start now.
Welcome, everybody. This is Jeff Fowler with the Apartment Owners Association. It's great to have you with us today. We're going to be talking about a low-cost solution for housing providers, a low-cost 1031 solution for you. And before we get into that, um, our goal is to help you make and or keep more money than ever before. And this tax strategy is definitely one that'll help you keep more and then make more. And it's astounding to see what paying tax and then trying to create wealth after that, how that impacts it. And anyway, so we're excited about this one. And hey, everybody, high fives to everybody that got involved. I know so many of you donated to the AOA Political Action Committee. I know so many of you put up the lawn signs, asked for more, and man, we were busy and really running and gunning with Prop 33 and bringing it down with all of you. So glad that that did not pass and it was defeated by the widest margin yet. So I think the work that you guys put in really contributed to that. So we're very, very thankful for that. And man, it doesn't stop. So we're continually trying to advocate for you in other ways. There's just a lawsuit in LA, in the city of LA, that we're doing an amicus brief for, and hopefully this will help with property rights. And anyway, I won't go into it right now, but really we're here to help you. And our goal is that you would be as prosperous as possible in every way, but especially we want to get you the information that you need so that your real estate investments perform super well and better than, that we'd have really the best group here in the state. So we have a couple different live streams that are, or no, we have in-person things that are coming up here. On the 19th, we're going to be in Hawthorne, and there's a big tenant screening update. Some of you may have caught other stuff that we've done online, but we will be talking about that, and then there'll be a double header there in Hawthorne with one other speaker, and that's at 10 a.m. on the 19th. Go to aoausa.com and sign up for that one. And then also on the 20th, we have at the Marina Village in San Diego, we have another doubleheader. There it will be a major tenant screening update with an attorney who represents landlords and specifically in that type of litigation. So that'll be interesting. And he's at 2:30, and then at 3:30 we have a landlord tenant law attorney who mainly deals in evictions. He'll be speaking on San Diego tenant protection ordinance and also just California tenant protection ordinance. So that will be a great day. I'm looking at getting down there a little bit early, going to the dock house right there on the wharf where Marina Village is, and getting a nice sandwich and, just enjoying the fresh air out there. So hopefully we'll see you there. And if you're not getting our emails, definitely subscribe to the e-newsletter. Whether you're a member or not, you can subscribe. And then for this live stream, you can, if you're watching from aoausa.com, which I know some of you are, there's a little blue help button at the bottom right side of the screen, and you can enter questions in there, and they'll get those over to me. And then, of course, you guys can just write in there. So without any further ado, this event sponsored by Origin Investments. And they're a private real estate manager that helps high net worth investors, family offices, and advisors grow wealth through tax-efficient real estate solutions. They build, buy, and finance multifamily projects in fast-growing U.S. markets and offer 1031 exchanges through their Origin Exchange platform. And in 2023, they launched Origin Credit Advisors, which provides providing yield-focused multifamily debt investments. And so our speaker today He leads Origin Exchange, the 1031 exchange platform at Origin Investments. With over a decade in the alternative investment industry, he's helped syndicate over 10 billion in commercial real estate, including 500 million in 1031 exchanges. And I think he's just updating these numbers because he's just had a whole lot of activity. Our speaker holds an MBA from DePaul University and a bachelor's from Purdue. He is a CFA charter holder and lives in Elmhurst, Illinois, with his wife and 3 children. So it's really a pleasure to bring on Michael O'Shea. So thanks for joining us, Michael.
Yeah. Well, thanks, Jeff. Thanks for that nice introduction, and congratulations to you. I know some of those propositions were hard fought, a lot of yard signs, a lot of getting out there, and congratulations to you and all of your efforts out there in California. This is a presentation just to kind of get off the ground here that is really more advanced tax planning. This is talking about, I own some assets. There's going to be a tax liability if I sell it. I've got estate planning to think about, and it goes into a lot of detail about matching debt and equity, timeframes, how to split up assets, what to do if it's in a multi-member type deal. I will tell you, we're going to go through this pretty quickly. The purpose of this presentation is to just do a general overview, an introduction of Origin, who we are, what is a 1031 exchange, what is a 721 UPREIT, how could it potentially benefit you? And I will say there's going to be questions that come up. What about how I'm legally holding my asset? What about the debt that's against my asset? What would my experience look like if I did a 1031 exchange? That's what I'm here for. That's what I sit at Origin 24 hours a day to do, is to run our 1031 exchange group. So there's actually a link to book a call with me on your screen there. So you can go ahead and just click that link. You can find a time on my calendar if you just wanted to talk about your specific case, what the tax liabilities would be, etc., because we are going to go through the details. This is typically an hour-long presentation for CPAs. We're going to go through it much more quickly than that. So please feel free to find some time with me with that booking link, or you could just email me, M-O'Shea. So first letter, last name, M-O-S-H-E-A at origininvestments.com, M-O'Shea at origininvestments.com. So to kick it off, I think a lot of people say, well, like, who is Origin and where did you guys start? Why should I be interested in working with you? We're a very interesting firm in the way we were founded. It was really more of a family office. Our 2 founders, Michael Episcope and David Shear, based here in Chicago, they were traders at the Mercantile Exchange. Michael was actually named top 100 trader in the world twice by Trader Magazine. So suffice to say, they were very, very successful and built enough wealth by their early 30s where they wanted to protect their own capital as a full-time job. And so they formed Origin essentially as a family office to grow, invest, and protect their own personal wealth. So they performed extremely well investing in real estate deals, agnostic to whether it was equity or debt. And friends and family came on, then we started doing growth funds. And now advanced 17 years later that we've been in the business, we now have over 4,000 individual investment partners, such as yourselves, that invest with us. We have over 90 registered investment advisor partners. So this is a little out of date. We've actually added 10 RIA partners. These are financial advisory firms that will invest their capital with Origin. And you can see there we've got over $2 billion of equity under management. And so we focus specifically on multifamily real estate investment management. You can see where we buy. We've got offices in Chicago. That's our headquarters. We also have offices in Denver, Dallas, Nashville, and Charlotte, and we have deal officers in all of those markets. So if you think about what we do, we're investing in through the smile of the United States, the Carolinas through Florida and Texas, up through the Front Range of Colorado, where all the growth is. We do not invest in California. We do not invest in Chicago. We do not invest in New York. We do not invest in retail or office. We only invest in multifamily assets in the growth areas of the United States. And that's purposeful, and I'll talk about a little bit about that on the back end. I've been doing this for about 20 years, helping people invest in 1031 exchanges through a DST structure. And when I approached Origin about building out this platform, the main thing they came back to me with was, look, we're an institutional firm. We don't charge selling commissions. We don't charge high fees. DSTs are a very high fee transactional product. It doesn't fit within what we do at Origin. And so I said, well, there's nothing wrong with a DST wrapper. It's just a legal entity. We can create it where we're not subjecting those investors to such high fee loads, and they can have a better overall investor experience. And so we believe we've built a better mousetrap for the DST investor that's looking to get out of active day-to-day real estate and get into passive ownership of real estate without all the taxes and fees associated with traditional DSTs. So a little bit of this is going to be rudimentary. There's some people that maybe don't even know what a 1031 is. So we'll go through some of this quickly. Again, I'd encourage you, if any of this is interesting, or if you just want to go over it again, just use that booking link or send me an email and we can find time that works for you. When you hear some numbers today, 1031, 721, this is just IRS Section 1031 of the tax code, IRS Section 721 of the tax code. And this goes all the way back to 1921. This is settled case law. Basically, the Starker case. Mr. Starker was selling a farm and buying a new farm. He argued that it wasn't a sale and a new purchase, that it was simply an exchange of assets and the cost basis should roll over. And the IRS agreed with him. So sometimes you'll hear this called a Starker exchange. That's why. But Section 1031 says that if you own real estate, real property, and you're holding it for investment purposes, so it's not personal property, if you sell it and exchange it into more assets, more real property, then there's no tax liability. So it's 100% deferral. Of course, there's a lot of rules you have to follow, and we'll talk about some of those rules. If you are considering selling your property, this is surprising to a lot of people that it's not just the capital gains tax when you sell real estate. So take this quick example here. You're buying a property for $600,000 and you sell it for $1.2 million. Most people would say I have a $600,000 capital gain. It's $120,000 of taxes. But you also have to recapture your depreciation. That's at a 25% tax rate. There's state taxes in California as high as 13.3 or 14.3, depending on your income. And then net investment income tax is 3.8% on incomes over 250,000. If you sell a large piece of real estate, your income is going to be over that for the year. So in this quick example where somebody might have estimated they're paying 120,000 in taxes, you're actually paying $307,000 in taxes, a big difference. And when you do a 1031 exchange, you get to defer all state, local, and federal taxes, and all of that cash stays inside real estate working for you. As you work through your 1031 exchange, you're going to get asked quite frequently, what'd you pay for the property? What's your basis? How much have you depreciated? And so we actually have a calculator built right into our website. If you have your phone on you, you can take a picture of this QR code, or you could just go to origininvestments.com under the Origin Exchange tab, and you could scroll down to our calculator. What I really like about this is you enter all that information one time, and then there's a little button at the bottom that says email me a report. And you can take that report, put it in your folder, and as you work through your 1031 journey, you'll always have those numbers handy for you. Remember, it's just an estimate. We don't give tax advice. You'd have to talk to your CPA about what your actual tax liability would be. Okay, so I mentioned that you get 100% deferral if you do everything correctly, and that's a big if. This is typically the largest financial asset that most families own. This is typically the largest financial decision that most people make in their lives. If you do any of these things wrong, you will have to pay taxes to the IRS. The major one is the 1031 exchange timeline. Surprisingly, this isn't as well known as it should be. The majority of people ask me, oh yeah, isn't 180 days your timeline to do an exchange? Yes, 100%. However, if you look down there, it says 45 days. That is your deadline to ID a new property. Well, what does that mean? Well, you have to unambiguously identify a property that you're going to replace into. So I'm selling a farm at 123 Main Street, and I'm going to buy a multifamily property in La Jolla, California. You can identify up to 3 properties as part of your 45-day window. Once that 45-day window is over, you can only close on what you identified. So when people say like, don't I get 6 months to do an exchange? Not really. You get 45 days. So if you close on January 1, you have until February 15th to identify replacement property, which is kind of light speed in the commercial real estate world. And if your deal falls apart, if you identify a deal within your window and then you're out of the window and the deal falls apart, you can no longer do a 1031 exchange. So remember that 45-day identification window. All right, and we're going to go through some of these rules fairly quickly. Feel free to set up a call if you'd like to talk about anything in specific. There's 6 rules you basically have to follow. Number 1 is that it has to be like kind. That doesn't mean hotel for hotel or multifamily for multifamily. It just means real property held for investment purposes for the same. So you can sell raw land and you can buy an apartment. You could sell a hotel and you could buy a farm. They are all real property to each other. So you just see a couple examples over on the left-hand side of what typically qualifies as real property. Your primary residence, a vacation home that you live in most of the year does not qualify. But if it's a vacation home that you only use once a year and you rent it out, that will qualify. So there's some things that are on the edge. But you'll see down here, TIC interest and Delaware statutory trust. Those are the two ways that you can really securitize your capital and pool your investment with other investors and upgrade into a higher quality institutional piece of property. So we'll talk about that in a second. If you are selling personal property, REIT shares, interest in a partnership, that does not qualify as real property, even if the partnership owns real estate. And so in that example, you would have a capital gain, which you could put into a qualified opportunity zone fund. Origin is actually a syndicator of qualified opportunity zone funds as well. So if you have non-real estate gains, you can feel free to reach out about that as well. The major thing you have to do, and I've seen a lot of mistakes made here, is you have to engage a qualified intermediary. You can never take constructive receipt of the proceeds. The sale proceeds when you sell your real estate can never go to your pocket, to your bank account. So think about a QI as just an escrow agent. You have to set it up ahead of time. It takes 10 minutes. I would work with a very high quality QI where this is all they do. And then when you go to the closing table, the cash gets wired to the QI. That 45-day identification window, you would identify with the QI. Here's the properties I want to identify with you. Once you find a replacement property, the QI will actually wire that money directly to us as the sponsor or to the closing for the replacement property that you buy. So it's kind of a triangle. The cash goes from your sale to the QI and then over to the new property, and you've never touched the proceeds. So you have to use a qualified intermediary. This one comes up obviously very often. I mean, typically real estate is held through a partnership, LLC, something like that, corporation. And a lot of times you have different members. Sometimes they all agree and want to do the same things. A lot of times you have ABC LLC and member A is like, hey, I really want to do a 1031 exchange. And members B and C don't. Well, what do you do in that case? Well, you can't take the sale proceeds for A and roll it into a 1031 and then B and C do what they want with it. Because what they're selling is LLC interest or partnership interest. They're not selling real estate. So the LLC has to do the exchange. All right. So what do you do to fix this problem? There's a couple of things you could do. You could do a partial exchange where you wouldn't exchange all of it. You'd buy some of the other partners out. You could do a drop and swap where you drop from an LLC to a tenant in common. You could use our solution, which is a 721 UPREIT, where you would do the exchange and then you would convert to partnership interest, tax-free, and then members B and C could retitle it. So this slide is a little complicated for this particular discussion, but if this is something that is of interest to you, feel free to use my booking link and I will walk you through it. The last 3 of these rules kind of rhyme with each other. So remember, it has to be like kind for like kind. The money has to go to a QI. You have to have continuity of title. And then the last 3 are kind of like math. Okay, so there's 2 things you have to do. You have to roll over all of the net proceeds. So sale price minus debt, whatever that equity is, you have to roll it over, all of it. If you keep any cash from the sale, it's taxable. The second thing you have to do is you have to replace all of your debt. And we'll walk through a couple examples there. You cannot replace cash with mortgage. You can't go up in debt and pull out cash out of the sale, but you can replace mortgage with cash. So if you want to delever, you can add cash to a transaction. So we'll kind of talk about that. So let's just talk about a couple examples where you failed to complete a 1031 exchange. So on the left-hand side, we're selling a property for $1 million. We've got 40% loan to value on our sale. So at sale, you pay off your $400,000 note, you have $600,000 in your property, in your pocket. So let's say you found a property to replace that and it's worth 1.25 million. So you sold for one, you're rolling into 1.25. That's good. You're going up in value. The bank says, hey, we'll lend you 60% LTV. We'll give you a $750,000 loan. And so you just kind of do the math and go, well, oh, I only need to roll 500,000. So you've fully replaced all of your real estate. You fully replaced all of your debt, but you didn't roll over all of your cash. So this would actually be taxable to you. Second example, just kind of the opposite thing where you say, I'd rather just delever. So you find a property that's 600,000, you don't put any debt on it. You do roll over all of your equity in your pocket. All 600,000 goes into the new deal. But because you went from $1 million of real estate to 600,000, this is actually going to be taxable to you, even though you've rolled over all of your cash. So how do we fix it? So let's just stick with that same example. Your replacement property is 0% LTV. You've got 600K in there. So what would fix this problem for you? Well, number one is you can add debt. So let's say you went out and found 55% leverage. Now you've got 733,000 of debt. You've rolled over all of your equity, 600,000, and you've replaced 1.3 million of real estate. This would be tax-free to you. The second solution, as I mentioned before, if you really did want to just not have debt, you can replace debt with cash. So if you had the cash, you roll over the 600K from your sale, you add 400,000 from another account, and now you've got $1 million of real estate, and this would be a tax-free exchange for you. All right, so I mentioned Delaware Statutory Trust earlier in the presentation. What is a Delaware Statutory Trust? Well, it's a legal wrapper. The reason that we use these is because there's a full revenue ruling, 2004-86, that states an interest in a Delaware Statutory Trust qualifies as like kind for the purposes of a 1031 exchange. So we establish a trust. You'll hear the phrase DST quite often. The trust will own real property, and then you will own an undivided fractional interest in the DST. Well, why do people like that? Well, because it's a passive investment. So as people have acquired real estate through the younger part of their career and worked hard and skill and effort and negotiating, and the real estate has gone up in value, as you move along your investment life cycle, your priorities change, and you don't want to take phone calls. You don't want to deal with tenants. You don't want to deal with all the headaches of real estate. Maybe you want to move out of California and you want to buy something in Nashville, Tennessee, but you're not in Nashville. You don't know the properties. You don't know how to buy something there. A lot of problems. So a lot of people just want to reprioritize their lives, spend more time with their kids, have a passive investment where they're not actively managing on a day-to-day basis, and something that just kicks off an income stream. So what you're doing is you're exchanging out of the day-to-day management, and you're exchanging up into much higher quality institutional real estate. These are just a couple pictures. These are not current DSTs that we have in the market, but these are properties that we own in our portfolio. Remember, we only do multifamily. We only invest in the growth areas of the United States. So this is just to kind of give you an idea of the size, scope, scale, quality of assets that you would be investing into in an Origin Delaware Statutory Trust. Now, I mentioned when I came over here that our goal was to build a better mousetrap in the DST world. And one of the main challenges was that DSTs are typically highly transactional, meaning we're just putting this deal out here. We don't have any ownership in it. We're just putting it out there for you to invest into it. So we have no skin in the game. And they're highly feed. And in my opinion, there's nothing wrong with high fees if they're explained up front and everybody understands them. The problem with the DST market is that all of the fees are sort of hidden in a 200-page prospectus. And so what are some of those fees? If you invest in a typical DST today, you're paying selling commissions of 5 or 6%. You're paying the broker dealers, their disposition fees, upfront fees, finance coordination fees, where in some of these deals, the front end fee to you could be as high as 20%. So if you put $1 million into a deal, 800,000 buys real estate, 200,000 is gone in fees. And so at Origin, we just didn't think that was right from our family office perspective. We didn't feel like that was something we would invest into. And so we've eliminated them. And so we have no selling commissions. We work directly with investors. You can call Origin directly and invest with us today. There's no broker that you have to work through to invest with us. And so when you look at the structure of the DSTs that we put in the market, we didn't lower the fees by a few percentage points. I mean, we essentially eliminated them and created an institutionally priced, purpose-built DST for individual investors to come directly to us. We charge an acquisition fee on the front end, and that kind of pays us for going out and finding the property, negotiating and closing it. That's pretty much our only source of revenue on the front end. O&O expenses, if you're not familiar, that's just our cost to put the deal together. So that's not even a revenue source. That's basically us just reimbursing costs of legal fees and travel and things like that to raise the money for the fund. So if you invested in Origin DST, you've roughly got 97 cents of every dollar going into real estate. None of the other DSTs in the market come anywhere close to that. Okay, so that's kind of the DST. Now, one of the challenges that we saw with the traditional DST was the exit strategy. Like, how do I get out? So I'm in this deal, I've paid a high load. Now I've got to wait a while to overcome that load. And then I sell 5 to 6 years from now. And I roll into another DST. So it's kind of known as swap until you drop. You just keep rolling and rolling and rolling forever. Well, that adds a lot of risk, idiosyncratic risk. You're in a single asset forever for the rest of your life. Transactional risk. Every time you sell, there better be something that you want to roll into. You've got to match debt, match equity. You've got your 45 days. Maybe you don't like the DST properties that are available. So there's just a lot of risk with this swap until you drop and a lot of fees. And so the process that Origin put in place is the exit strategy as a 721 UPREIT into our diversified flagship fund called Origin Income Plus Fund. Okay. So Section 721 of the tax code just says if you contribute real property to a partnership in exchange for partnership interest, then that's tax-free. So like, let's say you had a $50 million apartment building and equity residential, right? Here in Chicago, huge multifamily REIT, say they wanted to buy it from you. And instead of giving you cash, they gave you partnership interest, right? Now you would own an interest in equity residential, you'd be diversified, and you wouldn't have paid any taxes. We can't necessarily do a single stage 721, right? You can't sell us your property for partnership interest because we don't want to buy your property. We don't buy properties in California. Our properties are typically 200 units plus, 50, 60 million plus. So it's very rare that we would want to buy an investor's property, right? So how do we do it, right? We do it through a two-stage solution where the first thing you do is exactly what I just said. You sell your property, you put it on the market, and then you will roll into a DST replacement property. We just sold out our first deal. That was down in Dallas. That was about a $40 million equity raise. It's called the Starling. If you want to Google the Starling in Princeton, Texas, you can kind of get an idea of what that asset looks like. We're under contract on another deal in Nashville. It's about an $84 million deal that was just delivered last year. And so your experience, your life cycle would look like this. I would sell my property. I would do a 1031 exchange. I would end up in this institutionally priced DST with Origin. And during those 2 years of ownership, you would get income. If it goes up in value, you get the appreciation. You can write the income off on your taxes through depreciation. It's a Schedule E investment. But after 2 years of ownership in the DST, our flagship real estate fund, Income Plus Fund, has the right to acquire your DST interest. So instead of giving you cash, we're going to give you stock or operating partnership units. So why would that benefit you? Well, the main reason is diversification, right? So think about it like instead of owning IBM stock, you own an interest in a tech mutual fund. Your downside risk is protected by owning many assets inside of a single vehicle, but also more liquidity, right? Our Income Plus Fund has quarterly redemptions. You can control the liquidity if you ever want to sell your interest down the road. Real estate's an all or nothing game, right? $1 million property, you either sell it for $1 million or you don't sell it and you get $0. Well, if you had $1 million in our fund and you wanted to pull out 100K, you could do that. So it actually enhances your liquidity. And then as far as estate planning goes, what a lot of people start to worry about is like the burden of management. Like who's going to take this over? Do my kids really want to be landlords? I know I don't want to sell it, but I also don't want to pay taxes. So it's really a problem. So if you roll it into the Income Plus Fund, now you own a security easily divisible up to your beneficiaries. They get a fully stepped up cost basis. If they want to sell it, they can sell it. If they want to hold it, they can hold it. No burden of management. So it really cleans up your estate and diversifies you. So really powerful. Couple last things, and then we'll kind of wrap this up here. This is something that we believe at our core, that one of the best paths to wealth is to stay invested for the very long term into risk assets without the frictional costs of transactional fees and taxes. Stay invested and let it grow. In other words, our friend Charlie Munger says the first rule of compounding is to never interrupt it. And so that's what we're doing in the 721 exchange. So I want to show you something that I've modeled here. This is a pretty simple example. You're selling for $1 million, you have $1 million property, and we're estimating that the taxes due on that are $700,000. So the red bar is really, really simple. We sell the property, we pay the taxes, we have $700,000 of cash after the sale. And so we're just investing that into a 60-40 portfolio. That's 60% stocks, 40% bonds, and letting that grow over our lifetime. The blue bar and the gray bar are the 721 UPREIT or the swap till you drop that I mentioned earlier. So both of them have the same front end load, 10%. Ours is much lower than that, but I'm just comparing apples to apples. And both of them the exact same rate of return, 10%. The only difference between the blue bar and the gray bar is that the gray bar, you're selling and paying fees again, selling and paying fees again. And you do that 3 times over the 15 years. So every 5 years, you're selling and paying fees over and over again. This is what I mentioned about hidden fees. So if you were this gray bar investor here, right, you started with $1 million, 15 years later, you have $3 million. So you'd actually be pretty happy with your advisor and say, man, this really did well. But if you would have just stayed invested without paying those fees, you could have had $3.8 million. It's actually a 23% increase in wealth. By the way, earning the exact same rate of return. Now, for many reasons, I think our Income Plus fund will highly outperform a portfolio of DSTs. DSTs are constrained, right? DSTs, you can't renegotiate the leases, you can't refinance the debt, low yielding type of investment. Once you go into the Income Plus fund, we dissolve the DST, and then we can go out and seek the best risk-adjusted returns at any given time. So this gap would most likely be much larger. And then you're never going to make it up paying taxes and putting it into a 60-40 portfolio. So 70% increase over paying taxes, 23% over. So this is really playing out. This is how you build generational wealth, is to keep it invested without paying all those frictional costs. Last thing I'd mention is our Income Plus fund. There's 2 ways to get in this deal. This is our flagship real estate fund. Remember, we only invest in multifamily. We only invest in the smile of the United States through those 11 target markets I mentioned. This is a fund that is targeting 5 to 7% cash on cash return and 3 to 4% inflation. So we're just trying to hit singles. Every once in a while we hit home runs, but it's meant to be income plus growth. Highly tax efficient, so you can expect 90% of your cash flow to be tax sheltered through depreciation, and get you somewhere in that 9 to 11% annualized rate of return, and just let that compound forever. We love multifamily. We are only investing in multifamily. That's very purposeful. Multifamily has the lowest risk of any commercial real estate asset that's out there. We're very bullish. We know we've seen a pullback in rents lately. We are actually one of the only companies in the United States that predicted a pullback in rents. And we're very bullish on 25 and 26 in the next decade for a lot of reasons. And we can talk about that individually, but multifamily is very easy to backfill. It's a need, it's not a want. It's subsidized by Fannie and Freddie. We're underhoused in this country severely. We're 8 to 9 quarters behind on new starts. So the delta between deliveries, which is high, and new starts, which is low, is the highest it's ever been. So we think there's going to be tremendously outpaced demand for the next decade in multifamily. And so we could be tactical. This is the most important thing to take away from this presentation. When you do a 721 exchange strategy with Origin, you date the DST, you're in it for 2 years, but then you marry the Income Plus fund. You could be in it for 20 years. Okay, so who knows what's going to happen in 2030, 2035, etc. Nobody knows. In the Income Plus fund, we can move around. We can buy, we can build, we can lend, depending on what's going to give us the best risk-adjusted return at that particular time. And so, number 1, it's multifamily. Number 2, it's tactical to protect that downside. And it bears out. So if you look at kind of our cumulative growth through inception, kind of going through COVID and a little bit of a dip, we've been very, very successful on total returns. And I think to put it in perspective, you look at these returns and you kind of like say, well, 2.3% trailing 1 year, that's not that great. Well, look at the benchmark, right? NCREIF Odyssey Index, which is a mouthful. This is just an index that tracks core commercial real estate across the United States in these large institutional funds. They're down 12% because they own common equity. If you own common equity and your NOI is not increasing and interest rates go up, the value of your assets goes down. And so you're just sitting there owning beta. With us, we switched. Instead of owning common equity, we switched to pref equity. We switched to lending. And so that is a 14-point delta over a 1 year time horizon. That's tremendous. And so we think this is where you're going to want to be for the very long term with your real estate risk capital. So just to summarize, lower fees. We're going to put more of your capital to work in real estate. You're going to exchange up into higher quality real estate. You're going to exchange out of the day-to-day management. And then we're going to be focused on the lowest risk, highest returning asset in commercial real estate, which is multifamily. So I mentioned, I'm obviously available for follow-up calls. We barely scratched the surface on this. One of the things that we could do is talk to your CPA. We could talk to your attorney. We could talk to your partners. I could build out models for you and show you how to match debt in our deals and just talk about your specific case. So there is my email address, moshay@origininvestments.com. If you are tech savvy, you can just take a picture of this. Well, you wouldn't take a picture, but just scan the QR code there. That takes you directly to my booking link. What's nice about that is find the time that's open for me. You book a link, it sends you an invite, it sends me an invite, and we have a 30-minute conversation together. So with that, I think that's a pretty good overview, Jeff. I appreciate you letting us present here today. And any questions that you have, I'm happy to chat through.
All right, great. So if you have a question, please go ahead and put that into the chat here. And if you're on AOAUSA.com, you can put it there and they'll get it over to me. Or if you're watching on YouTube or other platform, go ahead and put it in and we'll get to it. And just off the bat, for the Income Plus Fund, when it's transferred, so 2 years it's going to be transferred into there. So that's where when you exit the DST and go into that fund, they're paying how much are they paying? What are the costs that they're paying at that point, 2 years into it?
Yeah, that's a good question. They're not paying anything. So I mentioned we do have small fee load on the front end to get into the DST and acquisition fee. Once you get upreated 721 exchange into our portfolio, it would be at 100% of NAV. There's no disposition.
Okay, great. So just that fee. And then once you're in there, is there what's the yearly fee again?
So the fee on the Income Plus Fund, if you think about it, there's two ways to get into it. You could just invest cash coming through the front door, or you could be a DST investor through the back door. The fees are exactly the same for both investors, and that is 1.25% asset management fee on an annual basis, just charged on net assets, not gross assets, and then a 10% promote above a 6% hurdle on an annual basis. So that's our performance fee. If the fund earns less than 6%, then we don't earn a fee. If it earns more than 6%, then we earn 10% of the profits. You earn 90% of the profits. And it's important to remember all of the numbers I've quoted to you, cash flow, return, all the returns that we've gotten, those are all net of all of those fees.
Right. So it's appreciating. And so let's say you're taking out, let's say it's getting 6%, which is great. If it's getting that, let's say you're pulling some out every month, what are the fees for as you're selling that? Obviously, at that point, you're going to be hit with taxes.
Right.
But other than that, like, what is there a fee for selling?
Yeah, that's a good question. So if you ever want to sell real estate and put the money in your pocket, you're paying taxes, right? So
Right.
whether it's with us or another 1031 sponsor, or if you do it on your own. So you control your liquidity. If you do sell, it will be taxable to you. The way it works is your first shot at liquidity is 3 years after you do the exchange, right? 2 years in a DST. The first year in the Income Plus Fund is illiquid. So 3 years from now, and you would get out at 95% of net asset value if you chose to sell right away. After 4 years, it's 97 and a half. After 5 years, it's 100% of NAV.
Oh,
And
wow.
going forward, yeah.
Okay, so that's nice. So if you just wait 5 years, then at any point that you sell that off at, and whether it's the whole thing or a portion, it would be 100% that they'd get out from it.
Correct, exactly.
Okay,
Yep.
great. All right. Well, those are just like the little things
Yeah.
that I'd like to know about. That's great, Michael. Thank you so much for sharing. It's interesting when you look at how those numbers worked. I thought that was really interesting to see that, and we really appreciate you. Do we have any questions at all? I know I asked a few. Any other questions here? And okay, so I don't see any questions right now. Let me look real quick. Yeah, so yeah, anyway, I can't see them. So, all right, so we'll assume that we don't have questions.
Great.
Um, and then as far as contacting you, I believe that they can see your contact information. But go ahead and maybe your last slide had contact information on it too.
Yeah, and it's still up.
Okay, great.
I don't think I'm sharing my screen. I think you guys would have to switch it over, but origininvestments.com. If you're interested, I would definitely check that out. It's got a lot about our founders and our backstory, our portfolio. We've got different funds, private equity, private credit, opportunity zone funds are all on there. And my contact info would be on there as well, but it's just first initial, last name, Moshea, Moshea at
Uh,
origininvestments.com.
Great. Thank you. Thanks again, and thank you everybody for watching, and we'll see you next time.
Thank you. Appreciate it.